who's an interest rate strategist from JP Morgan in Sydney. Stephen Nash from Fig Securities with us in studio with Carson and I here today. And Sally, just to start with you, the Fed President Fisher, we've been mentioning some of his comments already on the show today, but basically this idea of whether QE2 could result in superordinary inflation, which is Fisher's view. What about JP Morgan's view on that one?
Yeah, good morning, Brooke. Well, I guess it's sort of important to distinguish over time horizons. I mean, we certainly don't think there's going to be an inflation problem in the US anytime soon, and in fact our economists have run some numbers which basically suggest that, you know, if you want US inflation to be sort of back around target type sort of levels, so maybe around sort of 1.5% or thereabouts in the US, maybe a bit closer to 2%, then the US is going to need to grow at 5.5% over the course of 2011, and I think we all know that's probably a bit of a pipe dream. But you know, certainly I think, you know, looking further out for the bond market, I mean, one of the things the Fed is trying to do is basically generate some growth and therefore generate some inflation. So at some point, all of this is going to be negative for bonds, but we just don't think that's going to be the case over the near term, and so we're actually still very constructive on the Treasury market. And in fact, if you actually look at, you know, what the Fed plans to buy versus what we think the Treasury is planning to issue over the next sort of 6 to 8 months, in certain parts of the curve, like the 10-year part of the curve, Fed buying is basically about 140% of expected gross issuance. So we're still pretty constructive and think yields can actually fall from here near term.
Stephen Nash, the problem is that, as Sally was saying, you know, job creation, you've got to add about 200,000 new jobs to the payrolls every month, do you not, to get growth back to where it needs to be. It's not happening. It's sort of obstinately about 50,000 shy each time. Yes. And some. You know, Fisher himself saying, look, it's simply that liquidity is not the problem. It's just this logjam. Liquidity is omnipresent, but it's not being used to hire US workers.
Yeah, well, at the moment, I think there's got to be some sort of incentive to substitute labour for capital. There's a lot of investment in capital, but in terms of new hires, it's just not happening. On the consumer side, obviously depressed because of house price movements and the omnipresent unemployment figures. So it's very difficult to break that. I think the Fed's doing what it can, and it really has been criticised by almost everyone. Europeans, even Russians, I'm hearing that everyone's getting stuck into the Fed about their easing program.
Well, Kevin Warsh is a Fed governor and has worked very closely with Ben Bernanke as well, even through the 2008 financial crisis, in terms of trying to get that credit flowing again. He was also raising doubts about the durable benefits for the economy, whether it will have any significant impact. Again, that issue of inflation. You just wonder, with all the criticism, where the US can go with this. Do they just have to pursue it from here on in?
Look, I think the Fed's doing what it can, and I think Bernanke's studied other instances of a similar type, particularly in Japan, and I think his conclusion in that case was that if the authorities don't act aggressively enough, early enough, there can be continued problems with deflation. So I suppose that's the approach, to hit the economy hard and stimulate growth as soon as possible and not to wait.
And so, Sally, what do you make of this jump up in the gold price as well, with the inflation concerns, I suppose?
Yeah, I guess it's not too unsurprising when we look at what played out overnight. I mean, not only do we have sort of, you know, I guess the market sort of gearing up and getting sort of bullish on the inflation story. There's obviously the weak US dollar story was playing a part in the gold price. But the other thing that's sort of really generating a little bit of interest is the resurgence of sort of sovereign concerns in peripheral Europe, particularly in Ireland. And you know, you've seen the CDS spreads of Irish sovereign and Portuguese sovereign debt move wider, you know, quite significantly over the last couple of weeks. So again, you know, gold is sort of playing, you know, it's a bit of an inflation hedge, but it's also a bit of a flight to quality trade, I guess, in a world where government bonds in certain jurisdictions don't look so great. So, you know, given our view that probably this situation in peripheral Europe is going to get worse before it gets better, I think the gold price probably has further to run.
Stephen, how do you understand, as Sally was saying there, you know, Treasury's not looking so attractive? Is that why we did see, I mean, you saw the yields falling modestly overnight now, and yet gold and silver rallying? That doesn't necessarily say that inflation is really what's concerning markets quite at the moment.
Look, I don't think inflation is a concern. I mean, the Fed has told you that inflation is too low, it's under target. I think that's part of the reason for the rally, and the idea is that there is a bubble. I think that's overplayed. I think inflation is really low. I mean, that's the fact. And as Sally said, it'll take quite a while for that to reverse. So, in the meantime, it's good times for bonds.
Is there a chance, when you're saying that there's no inflation problem for now, or deflation is obviously what they want to avoid with that,
Yeah.
that there's that bond bubble discussion, but do you feel that there's some sort of complacency about that within the bond market? Is there potential that there's some complacency when it comes maybe to the US consumer?
Look, I think if you're talking about the long end of the curve, the 30-year is not really participating in this rally, and I think that's probably the next phase in this rally. We've had the rally in the 10 years and everything else, shorter than that. The market, in terms of following this, the 30-year is just not participating. So I suppose the next phase will be an acceptance that the recovery will be slower than currently expected. Everyone's looking for that V, the ending V shape, and I think over time that'll be worn away and people will start buying those 30-year bonds.
You've got this interesting gulf now emerging as well between Germany, Europe's largest economy, not necessarily painting the Fed in a wonderful light. That has got to be of concern, because when the G20 comes together, it's just going to be another slanging match, isn't it? I mean, how's it going to play out?
It's shaping up to be quite a, as you say, slanging match. The Germans are describing the Fed as clueless. It's not going to be particularly, it's not a diplomatic phrase. And the Europeans have a different approach. They have this austerity approach. Well, is there anything going really well there at the moment? I don't think so. I think everyone's trying what they can, and the Americans are trying a different tack. And I think, given Bernanke's experience and study of what's happened in Japan, I think that's probably the right approach right now. It's not easy, but I think they're doing what they can.
Yeah, and Sally, Obama's response, I mean, he's having to defend, obviously, the US policy of quantitative easing. Do you think Obama saying basically no growth or limited growth in the United States is a threat to the entire world, that's why we're doing it? Is that a decent response to that, or a solid argument?
Well, I guess it's one way of looking at it. I mean, I don't know how much altruism there is in what the Fed's doing. I mean, it's a unilateral move, right? They're the only central bank that's really sort of pursuing quantitative easing now with, any sort of serious intent. So, I think the whole sort of criticising the Fed story has the potential to be, quite damaging, in the sense that if it strips away the Fed's credibility, then there's basically no point doing QE2. I mean, QE2 relies on the fact that, people believe the Fed will do what it says, and that will actually have some positive impact on the economy down the track. So all this sort of ongoing criticism and, sort of becoming, pretty fast and pretty thick from, all corners of the world, I'm not so sure is a positive thing for the US economy and probably the global economy as well. I mean, let's not forget, the US economy is still, the biggest part of global GDP. Won't be that way forever, but it is right here and now. So US growth does actually matter, and we saw, our own central bank governor, Glenn Stevens, reiterate that point just a couple of weeks ago. So, I think it's only early days in terms of the impact of QE2, and we need to give it a little bit longer. But in terms of the reaction, sort of late last week, we had a rally in bond markets, a rally in equity markets, slightly softer US dollar. That's what the Fed wants, and that's what the US economy needs if it's going to have any hope of generating some above-trend growth and eventually some inflation.
Do you buy this one about a softer dollar being what the US really needs, Stephen? Because I'm just thinking back, how many years was it ago when our dollar absolutely crumbled against the greenback? It went down below, it was around about the 40 US cent mark, was it not? And our central bank was in New York buying up billions worth of greenbacks to no avail. Eventually gave up and said, all right, you win. You're top dog. I mean, I know the world has now changed since that time, but it wasn't not a textbook lesson of how strong currencies ultimately define the strength of nations. Trying to devalue is just an artifice, and everyone really now swinging back to saying, if you can get the US back on track, it will be far more effective than the interventions of Japan, of the UK Bank of England, to try and bring their currencies lower, to try and fight this artificial position we've put ourselves into.
Well, I think the US are trying to stimulate some sort of growth, export growth, by sort of suggesting the currency should be lower.
I mean, they're trying to export their way out of this problem. It's not going to work.
The problem for them then is the Chinese currency situation, when they're manipulating their currency and they're saying the Chinese are
just a circular battle. I mean, why don't we just focus on shoring up growth domestically? Why does it all be about exports?
Well, I think that the US are trying every policy option they can, and currency has become the new, the last lever. And I think they're going to try to exploit that.
The new whipping boy, okay.
Thanks, Stephen Nash from Big Securities and Sally Old from JP Morgan. Appreciate both of your time today. Thanks.
Thank you.
Right,
And
Business Channel.